Good morning, everybody. Another beautiful day here in sunny South Florida. I'm here with the 412E3 Bureau again, Mr. Mark Ditondo. And today we're going to go over one line at a time, an illustration of a case that we currently have that we're working, which is a gentleman who is self-employed and makes $850,000 a year. So, Mark, it's all yours, my friend.
Good morning. Thank you, Mark. Good to be here. So today we're going to talk about a 412E3. A 412E3 is a fully insured defined benefit plan that allows a business owner maximum deductions for 2022. Lafayette Life is a provider of 412 products. We also provide the TPA service and the products inside of 412. So without further ado, let's just talk about a little bit about our financial strength. Lafayette Life is an A+ rated carrier with a 96 on 100 Comdex, very financially strong. As I mentioned, we provide TPA services, product support, and consultative services. So let's move on to this specific case. This specific case is a 61-year-old gentleman. We're going to fund this plan from age 61 to 66. So we're going to fund it for 5 years. As Mark mentioned earlier, his compensation is $850,000. The next page is going to show you what his contribution will be as a standalone 412 program. So someone age 61 making $850,000 can put away an amazing $409,977 inside of a 412 plan. That's every year for the next 5 years, minus dividends, which we will get into in a minute. So no, keep that page, please, Mark. So if you look at that, he's putting away $409,000. His company will save $163,991 in taxes, assuming they're in a 40% tax bracket. Okay, that's both state and federal.
So Mark,
some states are higher, some states are lower. We use a 40% bracket as just a mean. So Mark, he's putting away $409,000, saving $163,000. His net out-of-pocket expense is $245,000. So before he gets any type of rate of return, he's positive $163,991 every single year for the next 5 years.
So Mark, just to clear this up, to make sure everyone understands exactly what you're saying, he's writing off of the adjusted gross income line of his taxes, the $400,000 and change, correct?
Not his adjusted gross income. No, it's a company deduction. Oh, it's not a personal deduction. It's a company deduction.
You're right. I was thinking individual. So the company's tax return, he's taking a $409,000 and change dollar deduction off of his taxable income, correct?
Yeah. So to use an example, Mark, and that's a very good point. People think that it's personal income. It's actually corporate income. So if his corporate tax returns showed $1 million in profit, we would be subtracting $409,000 off the top line. So his net profit now would drop to, $591,000. Significant savings.
Great. Okay. Glad we cleared that up. Ready for the next page?
Sure. So a 412E3 plan is a fully insured plan. We use a nominal rate of return of 1%. And the reason why we do that, and don't be fearful of that, is so that we are allowed to get that $409,000 plus tax deduction or contribution, I should say. So we use, and the numbers that we show you here in this valuation statement are completely guaranteed by the insurance company. So there's no variation in this number. There's no fluctuation with market risk. There's no fluctuation in contribution. Whatever we show on this page is what he is going to get at age 66. So our lump sum surrender at retirement is $1,515,767. The insurance value is $313,000. with an annuity value of $1,202,750. So just to further elaborate on what a 412 truly is, a 412 is a fully insured plan that the federal government only allows whole life insurance and annuities. Whole life insurance can be up to 50% of the contribution, which enhances the contribution, or you can use annuity only. So that's how the product has to be. You can't use any other investment vehicles except for life insurance and annuities in a 412 plan. So we are guaranteeing him $1,515,767 in this plan. Now, how it actually works in the mechanics is when we use a life insurance contract, every year we use dividends to reduce. So his first year contribution is going to be $409,000. The next year contribution is going to be less the dividend. So his $409,000 in year 2 will be less the dividend. So it might be like $380,000, and that will be subtracted each year for the next 5 years. Okay.
Quick question, Mark. You ready?
Sure. Yes.
Okay. So we're deducting, as we talked about, from the taxes of the company. What happens when someone is a self-employed person? Does he have to have an LLC or sub S to make this work, or can he just be a sole proprietor?
No, sole proprietor can work perfectly fine. We would take it off his, we would take his income based on his Schedule C line 31. And again, it would still be his profits of his sole prop. So
Okay.
if his sole prop did the same example, if his sole prop did $1 million, we took 409, his sole prop will be taxed at, 591,000.
Awesome. That's good stuff. Now, one other question, just to be sure. So you can only use in a 412(b)(3) annuities and whole life. You cannot use IULs or UL. Am I correct in that?
Right, because in a 412, peeling back the onion a little bit, you could only use guaranteed products that have guaranteed values. There's no other product in the industry that has guaranteed values that are sustainable.
Okay. Very important question that I'm sure is going to come up with some folks. Thank you.
It will.
That. All right,
Yes.
ready for the next slide?
Yes, sir. So this is the breakdown of the amount of money that he's going to get. So the face amount of insurance, which, if he dies today, his beneficiary would get $2,437,640 tax-free. The premium is $176,000. All base insurance on a 412 and a cash balance. There are no riders allowed in a policy. You can't put paid up additions rider. You can't put term riders. So this is a fully commissionable $176,000 policy.
Great. Let's talk about real quick. If someone has a 412(b)(3) and they're still in the contribution phase and they pass,
Great
how's
question.
the calculation done on the death benefit?
Great question. So how the calculation is done on the death benefit is what we call net amount at risk. So we take the death benefit minus the cash value that goes to the beneficiary, actually goes to the trust first, and then to the beneficiary tax-free. So as an example, in this case, if he died in year 2 and there's $100,000 of cash value, we would subtract 100,000 from the 2,437,000. His wife would get 2.3 million in change tax-free, and that 100,000 would be rolled over to an inherited IRA along with the other investment portion, i.e. the annuity in this case, which you would get as a taxable benefit.
Okay, so you just said something. So the death benefit would be rolled over into an inherited IRA, correct?
No, the cash value would be rolled over into an inherited IRA.
Okay.
The death benefit would go to the beneficiary tax-free.
Good. Just want to make sure everyone hears that. That's because sometimes that's a mistake that occurs. Okay, let's
Well,
now
one of the
talk
biggest
about,
misnomers, Mark, is that life insurance is taxable inside qualified plans, and that is not the case at all. The net amount at risk is tax-free. That's an important statement.
next question. He's done funding the plan. He goes 5 years, he fully funds it. How does he extract the life insurance from the plan?
Okay, so he has 4 basic options to extract to take the life insurance out of the plan or just surrender. So option 1, Mark, is just surrender the life insurance and leave the $384,318 in the policy, and then he just takes the $1,587,000, which is the total investment, out and rolls it to an IRA. So that's option 1. Option 2 is he buys the policy out of the plan by paying the taxes on the cash value, not the contribution, on the cash value. So in this case, the cash value is $384,000. Every year, he's going to pay what they call a PS58 charge. That is also subtracted from the cash value as considered as paid in. So if that number is, say, $20,000, he would pay taxes on $364,000 in his personal tax bracket, not his corporate tax bracket. That's a big difference also. The third option is he buys the policy out of the plan using non-qualified asset that he sets up into a non-qualified asset. Could be another life insurance policy, could be another annuity, could be a CD, could be a brokerage account, could be any non-qualified asset. And essentially what we're going to do, because this plan has to be whole, we're going to swap money out. We're going to put $384,000 in, and we're going to take the life insurance out. Now he owns the life insurance as a non-qualified asset.
And the life insurance still has $384,000 in cash value?
That is correct.
Just wanna
All we're
make
doing
sure.
is swapping it out. The main purpose of this plan is to make the plan whole. So if we put the 384 into the plan, we can take 384 out.
Great. And what's the last way? Number 4?
Number 4 is we take a loan to pay the taxes on the plan, and we pay the taxes with the loan, and then we take the policy out. The policy will have a loan when it's outside of the plan.
So let me just make sure we all understand that. So I have the life insurance policy with $384,000 in cash value, correct?
Yes, sir.
And a nice whopping death benefit. I can say I'm going to borrow the money out of the cash value of the life insurance policy.
While it's in the plan.
Right. And then when it comes out, the loan is there. I still have to pay it back. I have to pay back the loan at some point.
You have to pay back
if
the loan,
I
and you have to
choose
pay
to.
you're going to pay the taxes on the loan to the government.
Right. Exactly.
Yep.
Not too bad. Good deal.
Yeah,
All right.
I personally like option 3 is, because it gives you an opportunity, because in this case, he's saving $166,000 a year in taxes. So let's just say we take half of that savings and we put it into a non-qualified product, whatever it may be. Then he just has the money, and the government subsidized his life insurance even further.
You're 100% correct, Mark. That's why you are the 412E3 guru. Ready for the next slide now?
Yes, sir. Okay, this plan has another option. He can take a monthly income if he so desires. So in this case, he would take out $6,639.06 per month for the rest of his life. And the question that always comes up is, what happens if he dies too soon? We would put in a spousal benefit option that his spouse would get 60% of that, of a lower number, but a number like that. So we can do a joint survivor also in that calculation. Okay. So in
Okay,
these plans, they have two options, which they choose at retirement, not today, either the lump sum of 1.5 million or 6,600 a month for the rest of his life.
okay, now, next item. That's why I think it's so important to make sure there's a lot of life insurance in here, so if he does pass, then the wife doesn't have to deal with this situation, does she?
No. So the beauty of this plan is we bought the plan out. So let's just say that we had 384,000 in a side fund after, and we just swapped the money out. He now has 2.4 million of tax-free death benefit that can go to his wife, his heirs, his favorite charity, college, religious organization, whatever his plans are.
Great, love it.
And it was, subsidized by almost $1 million by the federal government.
Can't get any better than that, can you?
No way. No way.
All right, so here we go. Here's the next slide.
Okay, these are just the plan provisions. As you can see, that we're showing the 3 highest years of his income for participation purposes as far as income. And the income in for 2022, guys, is based on 305,000. I know we're showing 850, and good for him that he makes that much money, but the benefits in the contribution limits are predicated on $305,000.
Right, and just so everyone understands that in this particular situation, this gentleman earns W-2 income, and he's also has an LLC, which when we explain this to him, he goes, okay, I'm gonna take 305,000 where I max out my benefit on this and put that in the LLC and leave the rest, and he wanted to leave the rest W-2. That was his choice.
But that's all he needs to do though, Mark. That's anything over 305 is just gravy and just shows up on as a proposal. So 305 is the magic number.
No, I gotcha. So I have a couple of questions for you. You ready?
Sure.
So in a situation where you have employees, let's just go back to the one that we did the other day where there was 2 dentists with 3 employees. The money that is going into the plan for the employees, that I'm just going to give you rough numbers. I think there was a total of 800 something thousand spent for the year, and 700,000 and change was the tax deduction for the 2 dentists, right?
Okay.
And I think the 3 employees was like 34, 40 something, and 32,000 was what was going in. Now, is that money a deduction for the employees?
Yes, all of it. So that's why I didn't want to stop you. The whole 800,000 is fully deductible, not the 700 going to the doctors. The whole 800,000.
Because it's being deducted from the corporation's income.
Right.
Got it. And the owners are seeing the benefit. And the most important thing in my mind is something that is how these works, is that if they had set up, let's say, a 401k, and the employee contributed and then left in 6 months, they would take that money with them. However, it's my understanding that you can have a time frame that they have to be there before they can take the 412(b)(3) with them. Is that correct?
Right. So Mark, in this example, you see vesting schedule right here in the bottom of the page. You see that?
Right.
This one has a 100% vesting in 3 years. So it's a cliff vesting. I'm not sure that's accurate. I think this software is wrong. I think it's a 6-year. I'm going to have to call Warner on this because I'm seeing it again for the 3rd time in 2 days. But this one shows a 3-year cliff vesting, meaning that they don't get any contribution benefit unless they stay 3 full years from the start of the plan. Because I typically, when I do the installation paperwork, I exclude previous service.
Got it. Okay. And if you're dealing with, employees, correct me if I'm wrong, the employees have to work over 1,000 hours to be included in the plan. So if they're under 1,000 hours, you don't have to include them. Is that correct?
Yes, and they have to be W-2 employees. 1099 are not included.
Phenomenal. All right, we're good. Appreciate your time, and
thank you.
Enjoy your weekend.
You too. Thank you. Have a good day.
Thanks, everybody. Bye.